Why don't we start with you, Chris? Why don't you give us a little quick one on your background and tell us what you've been doing.
Yeah, sure. Hi, everyone. Nice to see everyone. So I am at Cliffwater LLC. We are a alternative investment consultant. We advise on hedge funds, private equity funds, private credit, real assets. We advise on about 75 billion and have about 50 institutional clients. Some of our clients are quite large, U.S. public pension plans. Some of them are on the smaller side, endowments and foundations, and a few in between. Specifically, I'm on the hedge fund side, and specifically within hedge funds, I'm doing all of the non-fundamental strategies. So I have a counterpart who does a lot of the stock pickers and the bottoms-up long-short equity funds, and I'm doing all of the global macro, the quant funds, the relative value funds, market neutral, and increasingly the esoteric strategies, crypto, reinsurance, etc. So that's, just a little bit on my background, what I'm doing.
Thanks. Jason, you're up. Good to see you.
Yeah. So I'm with Highland Associates. We are an OCIO consultant. Our client base is all not-for-profit mission-based groups across the U.S., plus hospitals. We are not an alternative specialist. We have about 0.7 billion, and around 7 or 8 of that is in alternatives. So that's where I focus. Me and my team spend all our time on alts, and I spend the vast majority of my time on the liquid part of the book, mostly in non-correlated strategies, as we have other team members that can spend more of their time on private investments and more directional fundamental strategies.
Thanks. Well, why don't we start with a nice broad topic, and then maybe we can kind of whittle down a little bit. And Jason, I'm actually going to throw it to you first. What type of appetite are you seeing now as 2020 really starts to unfold, and we're actually getting towards our home stretch, right, with the election just around?
Sure.
What do you see an appetite? Why not?
Yeah, absolutely. And I think we're seeing appetite in 2 areas primarily. So I believe it was Catherine on an early panel that mentioned portable alpha. So we have a wide spectrum of portable alpha across a number of different strategies. Portable alpha can range from equity futures or some other futures with collateral management underneath, and a more plain vanilla type of portable alpha, to something that employs tactical trading strategies, non-directional strategies, things that have little to no correlation with equity or other, equity betas or other betas on top of it. I think we've seen an increase over the years in interest for non-correlated strategies, trading-oriented strategies, from appetite for things that are going to get you equity-like exposure with some excess return on top. So that's one area we've seen some interest. Another area we've seen some interest, I think, when we look at where rates are today, what the expectation is for bonds, in things that do require some balance sheet, that are going to soak up some capital that you can't do synthetically. Other strategies are going to be perhaps interesting there for those that don't want to earn 1%, give or take, and have your principal protected.
Joe, welcome. Oh, got to unmute, Joe. Lower left-hand corner.
Now we're going.
Doing well today. How about yourself?
Doing well. Down in Austin, Texas.
Oh, good.
And I've been in the futures industry for a long time. First allocation was to John Henry in 1981. So seen a lot over the years. A couple of years ago, a firm out of Baltimore bought our business. We had an entity called Meritage Capital, and Brown Advisory out of Baltimore bought us a couple of years ago, and so we operate inside of Brown. It's a firm that's headquartered in Baltimore, approximately 90 billion in client assets. About a third of that's institutional, about 2/3 of it are high net worth families. And
well, You came in
continue to
on
do a
the,
lot of work in alternatives.
so you came in on the back end of, our first real topic, and that was, the appetite for, tactical strategies. What have you seen so far in 2020?
Well, we've seen a fair bit of interest. It ranges really in two different aspects. One is pure diversification, where it's designed to be more of a hedge than an alpha generator. But then we've had a couple of other clients that are putting together portfolios that are combining absolute return strategies with some more trend or longer volatility strategies to have a defined bucket that is really an alpha type bucket. So we've seen some offense and some defense. I would say there was a bit of a disappointment with some existing clients in the failure to have really exceptional performance in the decline in the market in March and April, but it happened so quickly, it probably wasn't realistic, especially the trend-oriented managers could move as quickly, and we ended up with another V bottom. So it was pretty tough. It was a tough period to have exceptional performance unless your timing was absolutely perfect.
So we've had an exceptional increase in traffic coming through, with people kicking the tires and doing due diligence and eventually allocating to us. And it's been interesting to see how it's gone away from like the pick and choose to gathering it together and, hey, can you do this for us? So Chris, have you seen anything like that where instead of being able to identify single managers, there's more of looking at a shop and a group think, maybe group think's not the right expression, but a grouping of managers that maybe accomplish a goal?
What I would say, if I back up for a sec, I think what's interesting is to put the whole thing in context, because where we are today, 6 months after the crisis started, we still are in this near zero interest rate environment. So the flows that I do see, there's still this reach for yield, and it's finding its way into credit, private credit. So that's where the money has flown, probably from hedge funds to private credit. That's one of the big themes I've seen. The next big question is what to do with fixed income. This is what all of our clients are worried about, with interest rates this low, with the US 10-year at 60 basis points in negative real yields. There's a big question about, will we have the same flight to quality? And for nearly 30, 40 years, fixed income has played this amazing part of the portfolio. And what I see, and this is kind of my hope for the hedge fund industry, is that we'll see a shift from passive to active management, and from fixed income allocations to hedge fund allocations, because hedge funds in a lot of ways can play that stable piece within a portfolio. They can be diversified, they can be very low risk, and they can provide almost coupon-like returns. Within hedge fund strategies, I see, amazingly, investors are still chasing returns. Like, some of the most interesting strategies are the tech and the biotech funds that have the biggest returns, year to date. And we can all talk about growth versus value and if we're at a bubble here, but they are the ones that are actually seeing the most interest. But I think some of the smarter money, and there's also a lot of renewed interest in market neutral. And the one thing that the COVID period gave us in March, April, was a stress test to see who is long vol, to see who is uncorrelated, who is negatively correlated. And I'm seeing a lot of interest, to your question, finally, I'm seeing a lot of interest in these uncorrelated strategies. So within hedge funds, which unfortunately I think are probably seeing more outflows than inflows, the inflows that are going on within hedge funds are going to be to probably some long-short equity funds that have hit the ball out of the park in terms of year-to-date performance. And then secondarily, I think it's all going to be to a lot of interesting uncorrelated market neutral strategies right in our wheelhouse.
So Jason, I'm going to throw it over to you a little bit because, you know, Chris talked about the concern, you know, and it was in the other panel too, will fixed income really provide a hedge if there's a significant market sell-off or a sideways market for a number of years? So do you find that uncorrelated, let's call it a sector or a silo, becomes of much more emphasis for you? I'm sorry, Jason, that was for you.
Oh, apologies, yes, I cut out momentarily. So,
my fault.
In terms of the future state of the world, it's hard to imagine a path where fixed income provides the same type of protection versus an equity sell-off that it has in the past, especially where interest rates are today. Right? It's certainly feasible if you look at what's happening today. Right? I think the 10 years has moved a few basis points in the direction you would expect, but in the context of a 2% day on the S&P, it provides very little, if any, protection, right? So, unfortunately, I think the relationship in the short term may hold, but it will not be the same type of hedge. Longer term, if we see protracted weakness, I don't think it'll be a great hedge either. And going back to Chris's earlier point, negative real yields, it should be a rather poor hedge for any kind of inflation in your portfolio.
Even though we have negative real yields in U.S. 10-year, my gut feeling is that investors, if the U.S. 10-year goes negative, the nominal yield, I think then we'll finally question what it's doing in the portfolio. But I think until then, we've got a little room to run before people really start recognizing that they need to change up their asset allocation because fixed income is yielding so low.
Joe, throw in your 2 cents here.
One of the things that we've done for clients in the past and are showing them today is you've seen, the traditional charts that show the different equity sectors with different colors and how they change each year. We've simply shown clients the same thing in the hedge fund community that shows the different strategies from, it could be trend following to merger arb to convertible arb to any sort of relative value trades. And if you look at those charts, there are some that are sort of core, usually either in the second or third quartile. And there are some that are either first or last, like short selling is either the best or the worst. But if you take out the more volatile ones and you show them that if you do a basket of these strategies that are consistent performers, you can actually replicate a return profile that's similar to traditional fixed income with pretty low volatility. I think Chris, that's sort of what Chris was talking about. But we show it to them in a very simple way. Then you have to pick a portfolio of managers that make sure you have all those bases covered. And the client has to understand that there are certain times when correlations are going to go to 1, and that's not the time to get out of these strategies, but it's actually the biggest opportunity set for these particular strategies. And you can use some sort of trend or volatility complement to that sort of basket. And, I think have a pretty well-rounded portfolio, I think will be a very good substitute for fixed income over the next 3, 4, 5 years.
Jason, when you are looking at these uncorrelated assets, are you concerned about capacity, or are you comfortable gathering, a half a dozen smaller managers to accomplish a goal?
I think, we have the privilege of being able to look at some smaller strategies. I don't know that everyone does. I think a lot of that's a function of your team size, how much you have allocated to the space as well as other portfolio constraints. But I think by and large, when you think about institutions in terms of uncorrelated strategies, most people are not going to want to have 20 strategies in their portfolio, right? Which is why you see a lot of value for some bigger groups that want to have one or two allocations in these kind of alpha machines of the world, the Millenniums and Citadels, et cetera, right? They can layer returns. But I think for those institutions that have the ability to do the work and roll up their sleeves, you can go out and find interesting uncorrelated things. You can pair them together, and if they're uncorrelated with each other and negatively correlated, and some require balance sheet and some don't require any balance sheet, and you can build something that is attractive and somewhat unique, and provides a great solution for your portfolio, for clients in the case that it touches another end client. So capacity is important. I still think some very low capacity strategies are tough for even some smaller institutions. Like if you think about forward freight agreements or power, or some things that it's hard to find scalable strategies in. Can be very fragmented in terms of the manager, the GP base, and I think consequently it becomes difficult to spend a lot of time on a single strategy. But if you find something that is a little scalable, that you can put a couple hundred million work in, that has a couple hundred million of total capacity, then doing the work on individual managers makes sense.
I think that's one of the real rewarding parts of it, is to be able to go out and find talent and then provide some sort of structure for it. It's one of the things we work really hard at Typhon is to try to find those managers and then fit them together in pieces of a puzzle to really put things together. Chris, can you talk a little bit about that hurdle of a smaller niche manager and being able to group it together, and let's just say will a client have an appetite for that if you're able to put it all together?
Yeah, I think that's the only way that clients are able to digest emerging managers at this point. I think the hurdle rate is just, the bar is just very, very high, because I think we've seen some numbers. There's been outflows for, I think, 10 straight quarters from hedge funds. A lot of it is going into privates. The money that remains is, a lot of our clients have asked us, why should we keep our allocations to hedge funds? First quarter overall was not great for the hedge fund industry, probably because there's a lot of beta masqueraded as alpha. So the hedge fund industry lost money as a whole, and most hedge fund portfolios were hurt. So even though we talk about the protection of hedge funds, I don't know if they did a good job in the fourth quarter of 2018 and the first quarter of 2020. So it just makes it that much harder for smaller managers to break into portfolios. But because this first quarter was a litmus test for how well portfolios are hedged, and because clients now see this coming 2 or 3 years, and particularly this coming 3 months, right? We're 41 days away from the presidential elections, which is going to be one of the most volatile times for markets. We know that we can't just cross our fingers and be involved with and have portfolios full of beta. So I think the best positioned hedge funds are the ones that are diversified, not just one strategy, the ones that are nimble, that can move between different strategies depending on opportunity set, and the ones that prove themselves in the first quarter.
I think,
Joe, why don't you talk a little bit about that?
Yeah, I think the most important thing for an emerging manager, or let's say a modest sized manager, to understand that you have to have an institutional structure to really get any capital from an institutional investor. And normally that is a structure that has a lot of additional bodies than what they have on hand. So having a firm like yours that, you know, provides the back office, you know, marketing, accounting, in all the compliance infrastructure necessary to make an institutional investor comfortable is frankly critical. And you don't have very much of a chance of, if you're a manager that has $200 million or even $100 million and you've got 3 or 4 people, you're just not going to qualify. There's got to be some sort of buffer in between, or some safety net for the institutional investor to consider that manager as a part of the portfolio. It's just the reality of what we deal with, and the record is not necessarily as important as you might think it is.
You know, Joe, because, you know, you've been around the block a couple times, can you talk a little bit about how that structure has changed, you know, from the 80s all the way till now? I mean, you know, you've seen inflows and outflows into the business. You've seen the cycle, you know, come around. You know, what have you noticed is the biggest change, and then what do you see going forward?
I would say the first major change that happened in the industry is funds used to be self-administrated, and because of Madoff and a few other problems, now there has to be an independent administrator that essentially is verifying assets and returns and performance. I'd say that's the most major thing that's happened. But secondly, I think that there has to be certainly a big commitment to compliance, and to have someone that is, you know, 100% responsible for compliance and not doing multiple jobs. In a lot of small shops, the compliance officer could be doing a lot of other things, and that's just not gonna fly. The other thing I think is, in organizations, there's got to be redundancy. You know, in the old days, I remember going to see Richard Chilton, who was a very successful hedge fund manager early in his career. This is the early 90s, and I asked him why he spent his day, and he said, you know, during the daytime he traded the markets, in the afternoon he did research, and at night he tried to raise money. That's just not going to happen anymore. You've got to have the trader independent from the decision maker, and it's got to just be a professionally run organization today to attract a lot of capital.
Jason, you got anything on that?
Sure. I think I completely agree with Joe. I think the onus over the past 12 or so years, and I started in this business 15 or so years ago, so he certainly had a much more time to see it evolve than I have. But you know, the onus on ODD over the past decade has only gotten larger, right? So everyone has to be buttoned up in every way possible. But I do think we've seen, especially with emerging managers over the past few years, a shift to outsourcing certain key functions, right? There's certain things you can't really outsource, but you know, some view that differently, but you know, middle office or certain compliance things, but you need oversight in all these areas. You need independence and oversight, and I think that's kind of the central tenet of a lot of the ODD, right? To make sure that there's not any big conflicts, right? You can't have if you have hard to value assets, you can't have, you know, portfolio managers who are compensated for, you know, those assets doing well, sitting on that valuation committee and all of the like.
Yeah. You know, one comment I'll make is, you know, the smartest operators in this business I've seen over the years that are great traders or great investors, they understand that that's their skill set. And it's one thing to trade, it's another thing to run an investment management business. And the really smart guys, the really great traders that built successful businesses, brought in the professionals to run the business side of things. Sometimes it takes, these are highly intelligent, very confident people. Sometimes it takes them a little time to understand that it's very different in running a business than working inside a bank or something like that and being a trader or working at another firm. You know, suddenly you've got employees, you've got lawyers to deal with, you've got accountants to deal with, you've got clients to deal with, and you know, you don't need the distraction. You just need to be able to trade.
We got a couple questions on that, and I think the first one I'm going to give over to Chris. Is money flowing to real estate partnerships, or is it leaving?
I think the big question is what happens with CMBS. I mean, it's very clear that office space in New York and big cities is not going to be as valuable as it once was. So I think we have not approved any real estate deals over the past 6 months. I think it is net leaving, but I think it will also be a big opportunity when the dust settles.
You know, I'm seeing it with some of the real estate that I'm involved with in the Chicagoland area, and they're basically, you know, we're talking office space warehouses, right? 30-70 splits, 80-20, you know, 20-80 splits with the office to the warehouse. And you'd think warehouses would be all right, but even in that, we're seeing rent rolls, you know, not being paid from businesses that are still functioning in some way, shape, or form. So it's concern, and I don't really have a view of like what does that mean going forward. You know, you think if you were a landscaping company and you need a place to store all your equipment, that would be a necessity. So I don't, you know, sometimes I wonder, is it taking advantage of a situation, or is there true hardship with it? I kind of grope for answers with that one. All right, we have another one here. Data shows that bonds have actually been better hedged the last few years than previously with lower yields. Would you expect this to break down? Couldn't rates go negative? Well, of course rates can go negative. Chris, I'm sorry, Jason, you got an outlook on interest rates?
Most, most consultants, large asset owners, capital markets expectations. And I think to get north of a 2% return on your fixed income portfolio over the next decade, you expect rates to slowly move higher. Right now, that'll offset slowly over time. It's not going to be a massive drag unless it happens all at once. But yes, of course, we've seen it in Europe, elsewhere in the world. Interest rates can go negative, and you know, bonds will continue to hedge, right? But here's the caveat, right? So in a 3% equity market move, if you have 50% bond allocation, how negative with a 5-6 duration do you have to go to hedge half of that? It's I think the directionality of the rates book, or the degree rather of bond rates that have to move to offset any kind of material equity weakness is so much larger today than I think is in anyone's expectation. So I don't think we're going to see negative 2-3% rates. I don't think that's feasible. It's certainly possible we see negative 50 basis points, negative 100 basis points. That's within the realm of expectation, despite, you know, Powell saying we're not going to have negative rates. But to see something that's going to move enough to fully hedge an equity portfolio that's experiencing a drawdown, it's hard to envision that working as well as it has in recent history.
Chris, are you in agreement with that?
Yeah, I have a rule of thumb. I mean, with the US 10-year at about 60 basis points, there is about 5% of upside if it goes to zero. And say that it goes to negative 50 basis points, which is where German bonds are for 10 years roughly, you'll get another 5%, right? So you've got a full 10% upside, and that's the US 10-year going to negative 50 basis points. There's a lot of jaw boning if it will go negative at all, but it's not a lot of upside for the downside. So the asymmetry is not in your favor, which is exactly what all of us in the macro world love to have in our favor, right? The asymmetry of trade where we have better upside than downside. So it's absolutely true that it performed out of expectations from during this last crisis, because there was the flight to quality and money flowed into the safe haven, which was U.S. Treasuries, which was the U.S. dollar. But at this point going forward, the truth is I would have said the same thing 2 years ago. 1 year ago, before the crisis, I would have said it's very risky to be in long fixed income. You don't have the same asymmetry. But now it's even more true. So, if we have another crisis, if we have a crisis surrounding the election and we have some unexpected turn of events and we get a big equity market sell-off, I think we are going to have a rally in fixed income. But the problem is that carrying at such a low nominal yield is not helping the portfolio in the good times. It probably will still help in the bad times, but it doesn't have that full package anymore. And that's why we're seeing such a big discussion about what to do from here going forward.
Chris. Joe, I'm going to kick it over to you if you have a comment.
No, I mean, I think there is a small possibility that the U.S. will go to negative interest rates, but I agree with our co-panelist here that the potential return is not not going to be beneficial enough to it's a big deal to go from 2 to 60 basis points or 2.5 to 60 basis points, but I can't see us going very much below zero. And I think it's just kind of anti-American, and that will be resisted at all cost. I think pension and large pools of money have a really, really serious problem as to what to do with their fixed income allocations. And we're looking for alternative sources of revenue generation for clients. One of the things we're looking at right now is a fund that, buys general partnership interest in private equity and some hedge funds. So I think if you're which carries some risk on its own, but I think it's going to be really tough period for the people who have objectives of 6 or 7 or 8% return on their portfolios. It's going to be a really tough time.
I will date myself a little bit and tell you that, my first real experience was working for a guy, Thomas Petterfee, back in '87. And my job was to keep our position delta neutral with the S&P futures. And people will ask about that experience and what was it like. I really kind of want to fast forward to February and March of this year and talk a little bit about that, but also how it colors the way you're going to evaluate managers from here on out. I know that that's been one of our challenges, is not to have it an overwhelming viewpoint of a manager that you're looking into. More, I guess we lean on their procedures. Like, how did they go about attacking this? Were they prepared for it? Were they not? What type of risk controls were in place? Jason, have you found your diligence with that period coloring it in a very different way?
Absolutely, Dave. I'd say, we think about some institutions that we work with have minimum, track record requirements. Now, within discretionary portfolios, we don't have those, but I think it provided a great data point, not only from an investment performance perspective, but it also provided a great data point from an operational perspective, because you could see how a firm behaved in a period of stress, right? Not only the portfolio, but how the people behave. Now, obviously in this environment where everything is virtual, getting in person and doing ODD presents its own challenges. But I think when you look at the strategies that held up well, right? There were certainly groups out there that had supposed long vol strategies that were long vol until Gambling blew up, and short dated options, and they were down half of what equity markets were, right? I think you look across the spectrum, and there were lots of groups out there that would portray themselves as being risk neutral, maybe even risk off, that didn't behave like that. And I think those that did gave a great data point. Now, we're going to face the same challenges the next time we have a large drawdown, right? The old adage about we're always fighting the last battle, and the next time will not look like the last time. And that's been true in almost every instance we've seen large drawdowns over time. So while I don't think it will be a pure kind of reference to go off of, I think it provides great color about how books are structured, how people hedge, and how all the pieces fit together.
Joe, I'm going to give you the final say, and just talk about, after all, with your breadth of experience, I always thought that, I'm trying to learn something new every day, right? And I'm open to new ideas and new ways of looking at things. What has February and March brought, and, opened your eyes to something that maybe you hadn't seen before?
Well, each environment's a bit different, and this happened very quickly. So we've tried to look at managers from two different perspectives. One is from a risk perspective, and how did they deal with the situation from a risk perspective. And secondly, really from more of an offensive and a decision-making perspective of, when did they choose to get comfortable again that the worst was over, so I think the most important was the risk side, which it always is do they understand to win the game they have to stay in the game, and staying in the game is not losing all your money. Staying in the game is keeping your clients happy, and staying within a volatility expectation that your clients have for you as an investor. And if you stay within that volatility constraint and communicate, you can hold your business together. But we had some people that re-engaged with the market very quickly, and we had others that, I wouldn't say they missed out totally, but they missed a lot of the rally going back. They're getting bailed out a little bit over the last day or two here, or last week or two, to maybe be able to get back in. But those are really the things that we're focusing on, and everybody's going to make a mistake in terms of timing of when they execute things. But did they follow their process? Did they execute risk control as we expected them to? And did they deviate from what our expectation was? Those are the real things that we try to look at. There we are.
Thank you, Joe, Chris, Jason, and David. That's fantastic. Sorry, we had a little bit of lag there. I think Clue actually got knocked off. But the panel is great, really helpful insights, I think for everybody here. So we really appreciate having you all here.
Okay. Thanks a lot. Enjoyed it.